Welcome back to the channel. My name is Brad, and today we're going to do the roundhill predictions for March 21st, 2025. XDTE, RDTE, and QDTE. If that is what you're looking for, stick around. So last week, I gave a prediction. I said that XDTE was going to pay 24 cents, QDTE was going to pay 23 cents, and RDTE was going to pay 29.8, and it came out with 24 cents, 23 cents, and 30 cents. Very close to exactly what I exactly said. I gave you their payouts 1 week in advance. So let's go ahead and see if we're going to have the same thing this week, and we'll go through the calls of each one. So let's look at XDTE. First thing I noticed is they went through the strike on the 5th. Yes, they went through the strike on the 5th, but they still made you 32 cents for the week. That is outstanding. Now, one thing I'm going to point out, and I will continue to point this out, is look at the quantity of strikes. It goes up, it goes down. I can tell you this week it went up and it went down. So they're selling these strikes. They're going to pay you those capital gains because they have to. That is just the rules. And we'll see how these affect your payments in the future. But for right now, you're going to make 32 cents. So take it and enjoy it. QDTE. QDTE didn't have anything go through the strike. And you can see that they made 27 cents, almost 28 cents. So good job on QDTE for their distributions coming up for next week. Not this week's, but next week's. If I look at the RUT, if I look at RDTE, nothing went through the strike. They're going to make you 30 cents per share. You're going to see share count go up and down. And I can tell you this week, share count went up and down. It is what it is. It went up and down. But we're going to just go ahead and go a little bit farther. March 21st, XDTE, it's going to be 32 cents, almost 33 cents. QDTE, 27 cents, almost 28 cents. RDTE, 30 cents, almost 31 cents. So there you have the predictions. Now let's go ahead, and I always add a little extra to this because I want you to get the full story. I'm going to leave a link to an article down in the pinned comment from one of my favorite authors now, and he is getting better and better. It's actually an editor's pick for Kevin, so good job, Kevin. I also have this. I'm going to leave a card up above to an audio version on the other channel, so you can go listen to it, just in case you're not a Seeking Alpha member. But if you're not a Seeking Alpha member, there is so many benefits to it. It's just unbelievable. Audio versions, go back and watch videos like they did that conference the other week. You can go back and watch each one of those individual videos, and I'm going to do a video about where you can find all that stuff because it's out there for you to enjoy at your leisure. You don't have to make a conference call in the middle of the day. But let's go into a couple charts that Kevin brought up in Kevin's article. By the way, Kevin raised this as a buy. That's the whole reason for the thumbnail. Buy, because maybe this is a buy. Not financial advice, legal advice, or any other advice. Just what Kevin said was a buy. The first chart he brought up was if you reinvested 50% back in, where would you be? And clearly, you're above board. So clearly, if you put $100,000 into XDTE and you reinvested 50%, you're still above board. See, he did the exact same test on XDTE with 25% reinvested, and you're just below. He did the analysis. It's not even my analysis. I just thought I would share it because I found his articles very interesting. And if you don't read them, I would read his articles. He does a pretty good job. I also think he follows me. I think he's a subscriber because he mentioned mark to mark, which I brought up last week or the week before about mark to mark and how that affects it. So he took that into consideration. His article also points out if it's a taxable account, that the taxable accounts, and he did the analysis, that you would be better off earning something else. But in a tax deferred account, you would be better off probably with XDTE. Just the difference between taxes. So he did a really good job of breaking that down. So highly recommend you reading his article or go listen to the article. The other one is I went through Portfolio Visualizer. I did this the other week. I'm going to do it again this week just for XDTE and QDTE against SPY. So I take out 0.67. 0.67 is equivalent of 8% annually, broken down to income per month. So I went 8% annually, which is 0.67 monthly. So that's how it does it in Portfolio Visualizer. It also does the complete income on current worth, not current cost. Just a little bit different, but that's how the software is made, and it makes it easy. So you can actually go run this test yourself, so you don't even have to believe my data. The data is on Portfolio Visualizer, and you can go do it yourself. It is free. So XDTE, well, lo and behold, XDTE, QDTE, and then SPY. Wow, if I look at that chart, you see that XDTE, QDTE end up at the exact same spot, more or less, after 1 year. And if you had SPY and you were trying to take out 8%, you have less money. That is very important. So you would have been better off having XDTE, QDTE over top of SPY instead of selling SPY every single month at 0.67 and selling your shares. You could have had XDTE and QDTE and had more money after a year. So those people that said, why don't you just own SPY and sell the shares of SPY? Sorry that you have less money than XDTE, QDTE over top of your SPY. So Brad still is not going to buy a synthetic. I have enough with my funds that I have personally picked, and they are income funds over top of growth funds. Somebody asked yesterday or today, why did I not sell all my income funds when the price of SPY fell below the 200-day moving average? And my comment is I guess I could live on the corner and beg for money, but no, it's income. Income is income. Growth is growth. I don't think people are separating the two. You will when you go to retirement and you have your income side and your growth side. This is retirement. This is not trying to grow that pot. And if I was growing the pots and I was in my 20s, maybe I wouldn't have sold. But I'm in my late 50s. I don't need my capital eroding right out from underneath of me in my growth side. That is just my opinion. You can do you, I can do me. But if you're in your 20s and 30s, it's a different story than you're 57. You don't have 10 years to think about recovery. Take that into account. You don't have forever to recover when you get older. So you got to be a lot more protective. That's just my conversation. The other one was, and I want to try to answer this at the end of this video. It was 10 months, and 10 months is 300 days. Well, unfortunately, the stock market is only open up 22 days a month. I think they don't realize the stock market is closed on Saturday and Sunday. And then you have holidays. If you add the holidays in, you're close to like 210. So 200-day simple moving average is basically 10 months. The difference of it is you're supposed to, by the rules, wait until it closes below the 200, but I knew it wasn't going to close below the 200, so I went ahead and jumped out. Now I will wait until it gets above the 200 and it closes above the 200 before I get back in. That is just me, and that is on my growth side. My income side, I just reinvest back in. That's what I'm going to do. And there's going to be a portfolio review on Friday, what I'm going to be doing over the next few months and how I'm going to build out my income side. And that's on Friday. I will do a follow-up to my growth side because I probably will not go back into IVV and QQQM on my growth side when I get back in. I think I will go to something maybe a little more conservative because I am older and I am in retirement, not trying to grow my account like a 35 or a 40-year-old. I need income. I live on my income. And I don't think people fully understand that until you actually start having to pull out money because that is your source of income. So until next time, God bless.